because the Fed is going to print their way to oblivion trying to prevent it. Now, unfortunately, this means that we're most likely going to experience what is called a hyperinflationary depression, as major conditions of both tragedies occur simultaneously. Now, this is a quick chart of the massive deflation that took place in 2008 and 2009 in housing prices, and the beginning of the second leg down that's begun here at the end of 2010. So with that expectation, I have two priorities. The first is to protect what I have. Now, for the past 2,400 years, a pattern has continually repeated in which governments debase and dilute their money supply until a point where the common psyche of the people and the collective mind of a country begin to feel that something isn't right. Now, they start to sense a loss of their purchasing power, and as the debasement progresses and continues, something miraculous happens. Through the free market system, the will of the public causes the only real money on the planet, which is gold and silver, to automatically revalue. And in so doing, it accounts for all of the currency that has been created since the last revaluation. Let me give you an example. At the beginning of World War I, Germany went off the gold standard so they could fund their war by revving up the printing presses. Well, the number of German marks in circulation increased by 400% during the war. Prices, however, did not keep up with inflation, so the side effects weren't really felt. That, in many ways, is what's been happening over the last year here. Now, the reason prices didn't increase with inflation is because in times of uncertainty, people tend to save their money. The last thing the general public is going to do in a time of war especially is go invest their money in the market or buy a new house. But by war's end, the sun started to shine, the dark times had come to pass, and it was time for prosperity. Confidence came back, and with it, the massive amount of currency that had been hoarded, causing rampant and instant inflation. Well, right before the end of World War I in 1918, the exchange rate between gold and the German mark was about 100 marks per ounce. So it took 100 marks to buy 1 ounce of gold. By 1920, it was 1,000 to 2,000 marks per ounce. Retail prices quickly followed, jumping 10 to 20 times. And in today's terms, that means that a gallon of gasoline would go from $3 to $30 to $60 per gallon. Now, by 1923, just 5 years later, the currency had fallen into hyperinflation, and the cost of a single chicken egg went from 8 cents to 80 billion marks within a 5-year time period. Anyone who had their savings or wealth in German marks lost absolutely everything. And you can actually see here the progression starting in 1919. German marks needed to buy 1 ounce of gold went from 170 all the way here by 1923 to 87 trillion. And how interesting is it that we broke the $1,400, $1,300, $1,400 mark in gold here recently this year, and it's been floating around there for about a year now. It'll probably float around there for another year, and then all of a sudden, when things started to recover and people started to put their money back in the market, look what happened here and how quickly that happened. So interesting numbers to pay attention to, and that really is the point here. Again, if you owned an ounce of gold, it had risen in value from 100 marks to 87 trillion, which in and of itself doesn't really mean anything when eggs cost 80 billion apiece. But what that ounce of gold allowed you to do was to retain the wealth that you had worked for years to acquire and to protect it from inflation. So at the end of the day, the poor were still poor, the rich who knew the value of gold were still rich. But the middle class who had put its faith in the government and the currency, were completely wiped out. Just imagine if you had $100,000 in a saving account today to put towards your retirement, what that would be worth when a gallon of milk costs you $100,000. That's how you lose everything and you fall into bankruptcy, unfortunately, during a highly inflationary scenario like this, just like what happened here in Germany. The wealth transfer was so great, and that's really what we're talking about here, is all the wealth that fiat currency represented was transferred into gold and silver. And so you could actually go back and buy an entire city block in downtown Germany for 25 ounces of gold, which in today's prices is roughly $35,000, $45,000. where it is today around 1400, it's right around there. The lesson here is this: energy is never destroyed. Wealth is never destroyed. It is only transferred from one agent of value to another. And without exception, every single fiat currency that has ever been created has been destroyed. And also, without exception, the value agent of last resort during its death has always been gold and silver. The track record is flawless. But it's important to remember, the purpose of buying gold is not to hoard gold. It's simply to recognize this cycle for what it is and to invest in the proper vehicle at the proper time. The ultimate goal is to accumulate passive cash flow assets like commercial real estate or dividend stocks, but to do it in time with the cycle that we're in and not against it. This is a nice illustration of what those cycles look like, which is the Dow-Gold ratio. Now, in 1971, the Case-Shiller home price index for a median single-family home was around $20,663. The price of silver back in 1971 is about $1.39 per ounce. That means it would have cost you 14,823 ounces of silver to buy that average family home that year. Well, the next 9 years consisted of a precious metals bull market. By 1980, the same house cost $42,747, and silver was up to $52.50 per ounce, which means it only required at that point 814 ounces of silver to buy that same exact home just 9 years later. The home had increased in price 2 times, or 100%. However, the currency supply during that same period had grown 2.45 times, and inflation increased throughout the 1970s. And while that resulted in the increase of a price in real estate, the actual value of that real estate against silver declined significantly, which had risen to 3,641%. So if you bought a home in 1971 and you sold it 9 years later in 1980, you made a 100% return. Yeah, that's all right. On the other hand, if you had invested in silver, you made a 3,641% return. So here's something to think about. If you had then sold your house in 1971 for 20 grand in pocket change and purchased silver with that money at that point, by January 1980, your investment would have outpaced real estate by a factor of 17, growing to $770,000 in just 9 years. Now, if you then sold your silver, at that point in 1980, you could go and buy 18 median family-priced homes in cash at the price of $42,747. That's pretty freaking amazing. And that's the situation we're in today, but it's better. Real estate has become much more overvalued, and silver has become extremely undervalued. Measured against silver, the median-priced single-family home in the U.S. peaked in 2001 at 38,123 ounces of silver. So it would have taken you that much silver to buy the average home in 2001. Today, silver stockpiles are only a fraction of what they were in 1980. This month, a 500-ounce box of silver would cost you around $15,000. A median-priced home would cost you around $200,000. So keeping in mind that in 1980, when silver reached its peak against real estate, it only took 814 ounces to buy that house. Well, that essentially means that when the cycle repeats this time, you'd be able to buy that home with only $24,420 worth of silver if you purchase that silver today at $30 an ounce. Okay, so when this cycle repeats, and if it does just as well as it did in 1980, you could go out and buy a $200,000 home today, roughly, for 24 grand in silver if you go buy that silver today at 30 bucks an ounce. And it gets better. Recently, Adrian Douglas of GATA.org made the case for $936 per ounce in silver and $56,000 per ounce for gold. Well, basically, it's come to light that the bullion banks around the world have leased all of their gold and silver at a rate of 45 to 1. That means that for every 1 ounce of metal they physically own, they've sold the rights to that same metal to 45 other people who all think that they have the same claim to it, who all think they have it sitting in their nice little Swiss vault somewhere. As demand for physical delivery of this metal by the potential owners continues to increase, it's going to cause that leverage to unwind, increasing the price of silver today from from $30 to ounce. It keeps going up. I can't keep track anymore. From $30 an ounce to $990, and gold from $1,400 an ounce to $56,000 an ounce if you get rid of that 45 to 1 leverage. Now, it's also important to note that unlike 1980, today we're in the midst of a currency war as every major nation races to devalue their currency against the dollar. Today's economic crisis is not about stocks or housing. Okay? The crisis is not about stocks or housing. This is the final chapter in the life of another fiat currency that has been abused beyond the point of no return, which also means the largest wealth transfer in history is underway as everything reverts back to its true unleveraged value, which is intrinsically zero for a fiat currency. Now, whether that's good news or bad news will depend upon which asset class you're invested in. Personally, I went all in gold and silver starting in 2007 and 2008 when gold was less than $800 an ounce and silver was less than $10 an ounce. But ladies and gentlemen, I have to tell you this right now. This is the single most important part of this presentation. If you're not leaning forward in your chair, please do so right now. What is your next move? So let's say that you pick up some precious metals and you position yourself on the winning side of this wealth transfer during the next couple of years. There will come a day when the gold bubble bursts, just like the real estate bubble did, and just like the tech bubble before that did, which means you're going to need to know two things beforehand. First, when to sell and get out of metals before they plummet, because they will. But most important of all, where to put your money next. That is the million-dollar question that has driven me for 3 years, because buying gold and silver right now is simple, is easy, it's common sense. But knowing what assets to buy and how to buy them in today's new economy will determine how wealthy or poor you become. I don't know about you, but I wasn't raised with a real education in wealth creation. I grew up in a middle-class family with hardworking, honest parents who did the exact same thing that everybody else did with their money. They handed it over to a financial advisor, quote unquote, who invested it for the long term in a diversified portfolio of mutual funds and a Roth IRA. And along with everybody else, they have since lost a sizable portion of their retirement over the last few years that they will never, ever get back. Well, those days are over. And you'd have to be, in my opinion, an absolute fool to hand your money over to anyone in that industry again who is still trying to sell you on the same methodologies and the same products. The lesson for me has been loud and clear. If you stick your money into the vehicles used by the rest of middle-class America, you're going to get sheared with the rest of the sheep. Now, if you want to become rich these days, you have to invest your money like the rich do, which sounds great in theory, I know, but there is one little problem. There aren't any books or courses out there in the world that show you how to do that. And I know this for a fact because I've spent the last 2 years looking for them. And yes, there are hundreds of books on making money with real estate, forex, stocks, options, trading, but those are just singular tools and skill sets that are used to generate cash flow or offset taxes. When it comes to a true blueprint for unlimited wealth creation, it doesn't exist. And once you sit down and think about it, it's not really that surprising. I mean, after all, people who are extremely rich typically don't want to talk about it, let alone write a book about how they did it, which means this kind of knowledge is basically trapped inside a black box that is hidden from the general public like you and I. But that can't be an excuse because time is too short and the stakes are just too large right now for you to sit on the sidelines and do nothing. The time is right now. It's not next week, it's not next year, okay? With every day that goes by, the window of opportunity gets smaller and smaller and the risks of inaction get larger and larger. So I decided to take matters into my own hands and to crack open that box myself. I really didn't have a choice. The result began as a simple passion project I created for myself and a few close friends of mine that I nicknamed the Elevation Group. And the strategy was very simple. There are 3 things you need in order to get yourself out of the middle class investment slaughterhouse and into the world of the rich. The first is that you need cutting-edge inside information from people who really know what's going on, not from the talking heads on CNBC or from freaking Kramer or those idiots, frankly, or from your advisor who's let you down and who's lost the vast majority of your money. and who's only regurgitating the company mantras that are designed to sell you on more of their stupid products. So that's the first thing you need. Inside information, the real stuff.